Everybody tells you the same thing. Buy index funds, set it and forget it. Don't try to beat the market. And for the most part, that's good advice. But here's what nobody mentions. When everyone follows the same advice, something breaks. Right now, more than half of all money in US stock markets is in passive index funds. And that number is growing every year. What happens when most of the market stops thinking? Let's start with why index funds got so popular in the first place. In 1976, Jack Bogle created the first index fund at Vanguard. The idea was simple. Instead of paying expensive fund managers to pick stocks, and most of them failed to beat the market anyway, just buy every stock in the index. It worked. Low fees, broad diversification, and over time, index funds beat about 80% of actively managed funds. The data is overwhelming, so everyone piled in. In 2000, passive funds held about 15% of US stock market assets. By 2015, it was 35%. In 2025, it's over 55%. And if you count ETFs that track indices, it's even higher. This is one of the most dramatic shifts in financial history. More money is now managed by algorithms that mindlessly follow an index than by humans who actually research companies. And that's where the problem starts. Here's what an index fund actually does. When you put money into an S&P 500 index fund, your money gets split across all 500 companies, proportional to their size. Apple gets the most because it's the biggest. The smallest company in the index gets almost nothing. The fund doesn't think. It doesn't research. It doesn't ask, is Apple overvalued at this price? It just buys. This process is called price discovery, the market's way of figuring out what a company is actually worth. When active investors research a company, decide it's overvalued, and sell, that pushes the price down. When they decide it's undervalued and buy, that pushes the price up. Index funds don't participate in this process at all. They buy everything at whatever price the market says. They are price takers, not price makers. When 55% of the market is just buying and holding without thinking, the remaining 45% has to do all the work of figuring out what things are worth. Price discovery gets worse. Prices become less accurate, and that creates opportunities for manipulation. There's a second problem that's even more dangerous. The S&P 500 is weighted by market capitalization. That means the biggest companies get the biggest slice. Right now, the top 10 companies in the S&P 500 make up about 35% of the entire index. Think about what this means. When you buy an index fund for diversification, more than a third of your money goes to just 10 companies. Apple, Microsoft, Google, Amazon, Nvidia, you basically made a concentrated tech bet. And here's the feedback loop. When money flows into index funds, it automatically buys more of the biggest stocks. That pushes their prices up, which makes them an even larger percentage of the index, which means even more money flows into them next time. The big get bigger, not because they're earning more, but because the structure of indexing funnels money to whatever is already large. This is not diversification. This is momentum disguised as safety. And here's the part that keeps finance professors up at night. Index funds promise liquidity. You can sell any day. Your money is not locked up. But what happens when everyone tries to sell at the same time? During the COVID crash in March 2020, bond index funds dropped way more than the actual bonds they held. Why? Because the fund had to sell bonds to meet redemptions, but nobody wanted to buy. The price of the fund disconnected from the price of its holdings. For stocks, it hasn't happened at this scale yet, but the math is uncomfortable. If passive funds hold 55% of the market, and to say here is a panic, and everyone hits sell, who's the buyer? The active investors who only control 45% don't have enough capital to absorb a mass sell-off. It's like a movie theater, where more than half the audience is sitting in a section with no exit. As long as nobody yells fire, everything is fine. One more thing. When you buy an index fund, you become a shareholder of every company in the index. That means you get voting rights. But who actually votes? Not you. The fund manager does, and the three biggest index fund providers, BlackRock, Vanguard, and State Street, now collectively control about 25% of the votes at every major U.S. 3 firms, 25% of all votes. Not because they invested their own money, but because millions of people put money into their index funds. They have enormous power over corporate decisions, executive pay, board seats, climate policy, mergers, and they exercise that power with a tiny team of people. This was never the plan. Nobody voted for this concentration of corporate power. It just happened as a side effect of everyone following the same perfectly reasonable investment advice. So should you sell your index funds? No. Index funds are still the best option for most people. The fees are low, the diversification is real, and over the long term, they outperform most alternatives. But you should understand what you own. You're not buying the market. You're buying a specific structure that has specific risks. Some things to consider. If most of your index fund is tech stocks, maybe add some international or small cap exposure for real diversification. Don't assume that because it's called an index fund, it's automatically safe, and be aware that in a true panic, liquidity might not be there. Rule number 4. Understand what you own. Even if what you own is supposed to be simple, the safest sounding investment can hide the most structural risk. Next time, how banks use your deposits to make money at your expense.